Chapter 10. Where are the rabbits? One of the most remarkable features in our domesticated races is that we see in them adaptation, not indeed to the animals' or plants' own good, but to man's use of fancy. The key is man's power of accumulative selection. Nature gives successive variations, man adds them up in certain directions useful to him. In this sense he may be said to make useful breeds. Charles Darwin, On the Origin of Species, Chapter 1, Variation under Domestication. Despite the enthusiasm for activity that has swept business and financial America, we will stick with our till death do us part policy. It's the only one with which Charlie and I are comfortable. It produces decent results, and it lets our managers and those of our investees run their businesses free of distractions. Warren Buffett, Annual Letter to Shareholders, 1986. In October 1988, Forbes published a list of the 400 wealthiest Americans. Sam Walton was the richest with a fortune of $6.7 billion, and Buffett was ranked 10th with $2.2 billion. The list was full of familiar names, including Gates, Helmsley, Hillman, Kluge, Mars, Newhouse, Packard, Perot, Pritzker, and Redstone. But who was Shelby Cullom Davis? Almost no one had heard of him. And how was he ranked as high as 197 while being a new entrant? Davis was tucked between the famous names of Joseph Albertson, the founder of the Albertson Stores, and Fritz Otto Haas, the founder of the global multinational chemical company Röhm and Haas. But what had he founded? Forbes mentioned that he was worth $370 million, was from Tarrytown, New York, and had created his wealth from investment banking. However, Forbes was not entirely correct. Shelby Davis was not an investment banker. Unlike everyone else on the list, he was not an entrepreneur and did not own a business. He was an investor like Buffett. But the similarity appeared to stop there. First, Buffett was a professional investor managing money for others, whereas Davis invested his own money or his wife's. Second, Buffett started investing in his early 20s, whereas Davis did not start investing until he was 38 years old. Third, Buffett had studied finance and investing under the great Benjamin Graham. Davis had had no interest in economics or finance during his college days. Instead, he had majored in history and had a special love for the Russian Revolution. Finally, Buffett had spent his entire career investing. Davis had had at least 5 careers before age 40. He reported for CBS Radio. His first assignment was interviewing Amelia Earhart, was a freelance writer, and was a stock analyst, a statistician. He worked at the War Production Board in Washington during the Second World War and was a deputy superintendent in New York State's insurance department. Even Davis's investing style was radically different from Buffett's. Buffett invested across a range of industries, whereas just one sector contributed to Davis's colossal wealth. Buffett invested in very few businesses in the United States, whereas Davis invested in at least 1,600 businesses worldwide and occasionally traded heavily. But there was one way in which Davis and Buffett were alike, and it made Davis wealthier than most people who have ever lived on this planet. Darwin, the unappreciated math wizard. Darwin was a mathematical genius. But he didn't think so. On July 29, 1828, the 19-year-old Charles Darwin wrote a letter to his close friend and second cousin, William Darwin Fox. He started with a complaint and then rued his lack of mathematical prowess. What excuse have you to offer for not having answered my letter long before this? I hope it is nothing worse than idleness. Or what would be still better, I hope it arises from your being 10 fathoms deep in the mathematics, and if you are, God help you, for so am I, only with this difference I stick fast in the mud at the bottom and there I shall remain in status quo. Darwin reiterated his weakness in mathematics in his autobiography. After years I have deeply regretted that I did not proceed far enough at least to understand something of the great leading principles of mathematics. For men thus endowed seem to have an extra sense. He also admitted that the subject was repugnant to me. He detested complex mathematical formulations and once wrote to a friend, I have no faith in anything short of actual measurement and the rule of 3. The rule of 3 is a simple mathematical calculation that answers the problem: if 10 mangoes cost $8, how many mangoes can one buy for $40? I regard Darwin as a math genius because of his intuitive grasp of the prodigious power of long-term compounding. Most of his peers didn't understand it. In fact, neither did many of his successors. In Chapter 3 of Origin, Struggle for Existence, Darwin's exquisite grasp of the power of compounding is evident in his famous example of elephants. He wrote, "The elephant is reckoned to be the slowest breeder of all known animals, and I have taken some pains to estimate its probable minimum rate of increase. It will be under the mark to assume that it breeds when 30 years old, and goes on breeding till 90 years old, bringing forth 3 pair of young in this interval. If this be so, at the end of the 5th century there would be alive 15 million elephants, descended from the first pair." Like no one else before him, Darwin understood that an exponential increase of populations was theoretically possible but practically almost impossible. Diseases, predators, lack of food, natural disasters, and many other factors kept populations in check. This realization led him to conclude that only the fittest variants would survive to pass on their traits to their offspring. These fitter variants would then start exponentially increasing, leading to evolution through natural selection. As he famously wrote in Chapter 4 of Origin, "This preservation of favorable variations and the rejection of injurious variations I call natural selection." As I discussed earlier, Darwin's theory of natural selection had no place for sudden and dramatic changes. His theory required variations to be small and continuous and natural selection to work over very long periods through accumulated changes. Despite its glaring simplicity and explanatory power, or maybe because of it, his theory remained on the periphery of biological sciences during his lifetime and was not entirely accepted by the scientific community. In 1900, after the rediscovery of Gregor Mendel's work on heredity, Hugo de Vries, a well-respected Dutch botanist and geneticist, proposed a new theory of evolution called mutationism. According to this theory, the slight continuous variation proposed by Darwin could not lead to the evolution and creation of species, only significant mutations could. In his dimutations theory, the mutation theory, de Vries claimed that new species arise suddenly owing to discontinuous alteration. He wrote, "The new species thus originates suddenly, it is produced by the existing one without visible preparation and without transition." Now that everyone could understand. Intellectually, this was a much simpler assertion to understand than Darwinism because it could be visualized. Darwin's gradualism couldn't be. The world of investing is eerily similar. Everyone seems to know that the stock price of AMC, a movie theater chain, tripled in May 2021, but how many know that Home Depot's multiplied 140 times over 30 years from 1990 to 2020? According to mutationism, species are created not because of minor variations but because something big and strange happens that transforms the organism. The controversial debate between mutationism and Darwinism remained unresolved until the 1920s. Finally, mathematics rescued biology. Who would have thought? In the 1920s and 30s, the theoretical geneticists R. A. Fisher, J. B. S. Haldane, Sewell Wright, and a few others explained in complex mathematical language how continuous variation was compatible with Mendel's laws. Natural selection, acting cumulatively on minor variations, could produce significant evolutionary changes over surprisingly short periods. These acknowledged mathematical geniuses restated what Darwin had asserted almost 50 years earlier. He was saying that if a particular variation, say color vision, could give an individual a slight advantage over its peers, almost the entire population would be able to see in color over many fewer generations than we would imagine. Let us assume that color vision has a selective advantage of 1%, meaning that individuals with this trait produce 101 viable offspring instead of 100. Maybe color vision allows the individuals to locate higher quality fruits in the forest. Thus, the selective advantage here is equivalent to compound interest or annualized return. The advantage accumulates and grows exponentially over generations. Thus, in the second generation, the 101 offspring with color vision produce 10,201 offspring who can see color 101 times 101, whereas the 100 normal offspring produce 10,000 normal offspring, 100 times 100. This slight advantage compounded at 1% per generation yields dramatic change over time. Suppose there are 8 individuals with this trait, that is, color vision, among 1,000 individuals. Over how many generations do you think color vision would spread to 90% of the population? Only 3,000. Thus, if this were an organism with a lifespan of 1 month, most of the species would have color vision within 250 years with just a 1% selective advantage. In evolutionary terms, this is almost instantaneous transformation. And this is not just theory. Scientists observed the rapid evolution of peppered moths in Manchester, in Britain, in the 19th century. Peppered moths were generally white with small black splotches on their wings. They rested on lichen-covered tree trunks during the day where they were camouflaged against birds, their main predator. The species also had a rare, black-colored mutant. But it did not survive long because it was visible to birds against the background of tree trunks. As a result, most populations of peppered moths were, well, peppered. But as Manchester became industrialized from the middle of the 19th century, air pollution blackened tree trunks, thereby reversing the advantage. The black mutant became invisible to birds and the peppered form stood out. The first black peppered moth was recorded in Manchester in 1848, and by 1895, 98% of the population had become black. The cumulative impact of a slight advantage had converted the rare form into the dominant one. Interestingly, as Britain passed strict pollution laws in the middle of the 20th century, trees began to lose their sooty coating. As a result, the black moth has become rare and the peppered form is now dominant. This kind of microevolution, example, a change in color, given enough time, can lead to macroevolution, that is, the creation of a new species. There isn't a single mathematical formula in Darwin's origin. Still, it captures the power and essence of long-term compounding better than the complex formulas of the geneticists. Amazingly, a mathematically challenged naturalist could figure out what had eluded scientists over the millennia by applying a simple yet profound mathematical concept to the natural world. Compounding creates life, all of it. But why is this relevant for us investors? Because compounding also creates wealth. Almost all of it. The assault on Australia. We think we understand compounding, but we don't. By we, I mean the investment community, myself included. Although Nalanda's entire investing strategy rests on the pillar of slow and steady compounding over decades, even I am amazed at its stunning, even surreal results when applied over long periods. Before we proceed any further, I want you to appreciate its tremendous power. Then I will highlight two surprises, one small and one big, that cumulative growth has in store for students of evolution and investing. For this section, I will be an omniscient consultant. Are there any other kinds? In the 19th century, and you will be a savvy time traveler from 1925. Who said investment stories couldn't be exciting? Let's now go back in time to Winchelsea in Australia in 1859, where I am an advisor to one Mr. Thomas Austin. Mr. Austin has imported 24 rabbits from England and he wants to release them into the wild for sport hunting. He is an intelligent fellow and is wary of the rabbits' prodigious reproductive ability. As he does not wish the farmland in Winchelsea to be overrun by rabbits, he seeks my counsel. Just as I am about to advise him to release the rabbits, I see you swooping in from the future to issue a dire warning. I come from 1925 and see a catastrophe ahead. Don't release the rabbits. On further inquiry, you reveal that the whole of Australia is in peril because of these 24 creatures. I laugh at your facetious remark, ignore the warning, and ask Mr. Austin to release the rabbits. You promise to visit me every 5 to 10 years to continue to warn me about exterminating the rabbits. You fulfill your promise, and every time you come to see me, I ask the same question. Table 10.1 captures the history of our interactions. 35 years go by, and I continue to gloat over the fact that you have been proven wrong. There are fewer than 1 million rabbits in about 8 million square kilometers of land area, and they don't seem to pose any imminent danger. But you warn me that the historical growth rate is about 35% a year, and at this pace, Australia will be overtaken by rabbits in the not-too-distant future. As is my custom, I ignore the genie from the future. Table 10.2 tells the story of the next 31 years until 1925. This is a true story. Unfortunately, the 24 rabbits released by Mr. Austin in Australia in 1859 did produce 10 billion rabbits by 1925 and wreaked havoc on the flora and fauna of the continent. Despite more than 150 years of government efforts ranging from building fences, trapping, shooting, and conducting biological warfare, by releasing flies with the deadly myxoma virus, Australia has been unable to eliminate this pest. I said that there were two surprises in this story. The small surprise, at least for me, is that 24 rabbits became 10 billion. At some intuitive level, we investors understand that compounding can lead to astronomical numbers given enough time. But even then, I doubt many of us would have been able to envision a number of 10 billion rabbits in the mid-1920s when there had been fewer than 1 million in 1895. The bigger surprise, which is also counterintuitive, is the opposite observation: nothing happened for a very long time. After 20 years, not many rabbits would have been visible in Australia, and even after 45 years, there were fewer than 2 rabbits per square kilometer. So, Australians ignored the rabbit problem for many decades because rabbits did not become a problem. This property of compounding, that its impact seemingly remains hidden for a long time, wreaks havoc on the performance of investors because most sell too soon. An investor can hold a great business for 5 years, multiply their money 3 times, and then sell off for 2 potential reasons. First, they think that they have made enough and that there are better fish in the sea. Second, they get tired of the slow progress. After all, the share price of GameStop can jump 17-fold in a month. Little do they realize that if the share price had continued to climb at the same rate in 25 years, they would have made 243 times their money. I know that is a big if, but it isn't an insurmountable hurdle for a quality business, as we will soon see. Also, even if the incremental return from the 5th to the 25th year in this example falls by more than 5 percentage points, the investor would still make 100 times their money on the original investment. As I said, the bigger mystery of compounding is not that it leads to large numbers, but that it doesn't do so for a long time. The holding period of most funds is barely a few months, let alone years. If you explain this behavior to an intelligent non-investor type, I have done so, they will find it rather odd. They say something like this: you are telling me that it is tough to find great companies to invest in, you are also telling me that these companies can grow their profits reasonably predictably over long periods. So why would you sell such a company in a hurry after you have become fortunate enough to own it? I haven't had a good answer to this question, except my community is not willing to wait for the rabbits. I have seen too many people make a profit of 50 to 100% on an investment in a great company and then press the exit button. We investors take pride in being math savvy. Mention the word compounding to us and you will get knowing smiles. Unfortunately, most of those knowing smiles do not seem to know that what they know about compounding, that it can lead to big numbers over time, hides 2 great unknowns. The first is that compounding does not lead to significant numbers for a very long time. The second is that investing would be easy if companies could compound predictably. But alas, they don't. The real world is quite messy, and the path to long-term success is treacherous, unpredictable, and full of disappointments. What is needed to become a successful investor is not intellect, a commodity, but patience, which is not. Many more reasons we don't sell. Are we not convinced yet? With the power of compounding in evolutionary theory as the background, let me present some more reasons we are permanent owners in great businesses. I will never sell would be an understandable sentiment from a passionate entrepreneur, but it is somewhat unusual, some may even say wrong-headed, coming from a fund manager. It needs a more elaborate explanation. Here we go. Reason 1. Who are the richest? The ones who never sell. Have you looked at the Forbes list of the 25 wealthiest people in the world in 2022? In case you are interested, Elon Musk is the leader, $219 billion, and the 25th ranked is Zhang Yiming from China, $50 billion. This list consists entirely of people who have never sold. Even if you expand the list to the richest 50, 48 are business owners or their families who haven't sold. So, for example, there are 2 money managers, Jim Simons and Steven Schwartzman, on the list who may buy and sell shares as a part of their fund management business. Still, they haven't sold their businesses Renaissance and Blackstone, respectively, which, in turn, has made them billions. If not selling is creating such humongous wealth globally, why do fund managers think they can make themselves rich by trading in and out of stocks? I know that I am not smarter or better than the richest people in the world. But if holding on to great businesses has worked wonderfully for them, why should I not simply emulate them? Many entrepreneurs on this list have had attractive offers over their lifetime. The reason for their being on the list is that they did not succumb to temptation. They intuitively understood that they were on to something quite extraordinary and that selling would have been value-destroying, not value-creating. For example, in 2005, Viacom offered Mark Zuckerberg $75 million for Facebook, which would have made the 21-year-old a cool $35 million. Within a year of Viacom's offer, Yahoo offered $1 billion for the company. Zuckerberg refused both these and many other offers. His net worth in 2022? More than $50 billion. In one way, while we may not create as much wealth as these stalwarts, we are better off than them. They are betting on just one business, their own. We have the luxury of owning many great businesses. What could be better than that? Reason 2. Empirical evidence shows that owning great businesses works, oh so well. Let's go back to the Bessembinder study I referred to in the previous chapter. As a reminder, Bessembinder analyzed the price performance of 26,000 U.S. listed stocks from 1926 to 2016. He also shares the raw data from 1926 to 2019, which is available on the ASUWP Carey School of Business website. Let's look at data from 1926 to 2019. Decembinder defines wealth creation as returns earned above 1 month U.S. Treasuries. Of the 26,000 companies, about 60%, 15,000, destroyed value. This is not surprising. Running a business is risky, and the data support this assertion. But I was surprised by 2 facts. First, the quantum of wealth creation is almost 8 times the dollar value of wealth destruction, although wealth destroyers outnumber wealth creators by almost 40%. About 11,000 companies created a wealth of $54 trillion, and about 15,000 businesses destroyed a wealth of $7 trillion, leading to a net wealth creation of $47 trillion. When businesses do well, the sky's the limit. My second revelation was that only a select few companies created most of the wealth, even among the wealth creators, Table 10.3. Thus, the top 10%, or about 2,600 companies, account for all, actually 10% more, of the total wealth created by the 26,000 businesses. The top 1% contribute to 3/4, and just 30 firms account for almost a third of total wealth created over 93 years. An even more interesting finding is shown in the last column of Table 10.3. A disproportionate amount of wealth is created by businesses that have been held for longer periods. That does not mean that simply holding a business for an extended period creates value. It does not. The value will almost certainly go to zero for an average business. Table 10.3 shows that if we have a great business, on average, it is likely to generate more incredible wealth over a more extended period. But we have one prickly issue to deal with here. How do we know what a great business is so that we can hold it for as long as possible? I hope you did not start reading the book from this chapter. I discussed this question in chapters 1 through 7. We do not invest in mediocre or low-quality businesses at throwaway valuations because, as Table 10.3 shows, it would be a waste of time. Only a handful of companies create wealth over very long periods and, by definition, all need to be exceptional. Instead, we invest when we believe that the business is truly outstanding, and if it is, given the stark reality of Table 10.3, why would we ever sell it? I have been wrong about assessing the quality of some of our businesses. Since we hold all our businesses forever, the continuous compounding of earnings and value of a few businesses has taken care of all my follies. You want numbers? Coming at you. Reason 3, if there's an unbeatable formula, why not copy it? When I was at McKinsey, we addressed client problems by sharing best practices. These could range from advice related to post-merger integration, the process of strategy formulation, and organizational design to the allocation of marketing expenses. Of course, as a consultant, I had to account for the idiosyncrasies of a particular client. Still, I discovered that discussing how the best businesses do it was a great way to nudge a client toward a better solution. Here is a puzzle for you to chew on. I assume you will agree that all fund managers want to earn decent returns while beating the market over the long run. Imagine a situation in which a multi-billionaire investor shares his secret of getting rich with us every year in a detailed letter. His best practice is widely known and available to everyone, and it hasn't changed for more than 50 years. We know his advice is invaluable because he continues to amass great wealth by following his teachings over almost 6 decades. We also know that doing what he does is not difficult to understand or even implement, at least for the professionals. But most choose to both laud him and ignore him. That investor, of course, is Warren Buffett, and his simple advice to buy exceptional businesses at a sensible price and hold them forever has made him one of the wealthiest people in the world. So then why does his advice fall on deaf ears? At first glance, this seems somewhat bizarre. Investors seem to be voluntarily giving up the chance to get rich. But if you think about it for a moment, you will realize that Buffett's advice is hard to fathom for the same reason that Darwin's insight was not accepted for many decades. We humans don't understand compounding. We say we do, but we don't. Buffett is the Darwin of investing. He changed the field forever and for the better. But if eminent scientists in the late 19th and early 20th centuries could barely comprehend the power of cumulative growth, how can investors, who by and large are much more intellectually challenged, be expected to appreciate it? But the problem is worse than you think. Not only do investors blithely ignore Buffett, their behavior over the last 50 years indicates that they firmly believe the exact opposite. The holding period of stocks by mutual funds has fallen to less than a year from 7 years in 1960. Let's return to Shelby Cullom Davis. Despite being radically different from Buffett in almost every way, how did he create his wealth? Just like Buffett, Davis held on to a select few quality businesses for decades. Unlike Buffett, who always wanted to be an investor, Davis became an investor through a series of fortunate events. When he got married in January 1932, the Dow hit an all-time low of 41. It had fallen 89% from its peak in 1929. His wife, Catherine, provided him his seed money for investing many years later. Davis was lucky that Catherine's father, Joseph Wasserman, had kept his money in government bonds and lost nothing in the crash. After working as a reporter for CBS Radio, Davis earned his Ph.D. along with Catherine in political science at the University of Geneva, where Catherine outscored him. In 1934, Davis was offered a job in Tokyo at the English-language newspaper, The Advertiser. Just as he and Catherine were about to depart for Japan, an earthquake hit Tokyo, forcing them to cancel their trip. Also, The Advertiser offer fell through. Davis was now desperate for a job, but he could not find any employment in journalism in the sickening state of the U.S. economy. Catherine asked her brother, Bill, to employ Davis in his investment firm. Davis worked as a statistician in Bill's firm and traveled around the country meeting companies that looked promising for investment. But Davis and Bill did not get along, and Davis left the job to start writing full-time. He published a book called America Faces the 40s, which explored the causes of the Great Depression and how the 1940s might lead to recovery. It was reasonably well received and caught the eye of Thomas E. Dewey, the governor of New York and Republican presidential hopeful. He lost to Roosevelt in 1944 and to Truman in 1948. In 1938, Dewey made Davis his speechwriter and economic advisor. After losing to Roosevelt in 1944, Dewey returned to his role as the governor of New York. He unknowingly put Davis on the path to fabulous riches by appointing him the deputy superintendent of the state's insurance department. Could there be a more boring-sounding job? But Davis took it seriously. He was an outspoken advocate of insurance companies diversifying from bonds to real estate, mortgages, and stocks. Contrary to popular opinion in those days, Davis considered bonds extremely risky. Nevertheless, he was remarkably prescient. Bonds went into a 35-year bear market from the mid-1940s. The government bond sold for $101 in 1946, sold for just $17 in 1981. Investors ignored insurance companies, usually quoted in the minor league of stock exchanges. Insurers were required to file their latest financials with the state agency, and Davis pored over these reports, becoming an expert at understanding their inner workings. He discovered that a typical insurer was selling for less than its true book value. Just the bonds and mortgages in an insurer's portfolio could be worth far more than its market value. He realized that insurance customers paid money upfront and that insurers could deploy this float to buy bonds and mortgages. If customer claims weren't excessive, this hidden float could slowly and silently balloon over time. A patient investor could wait for this hidden asset to compound until the market, too, recognized it. Davis left his job in 1947, borrowed $50,000 from Catherine, and started investing in well-run and dividend-paying insurance companies selling for less than their book value. He also borrowed on the margin to fund some of his purchases. In a speech to the New York Insurance Brokers Association in 1952, Davis outlined his 3 criteria for selecting the stock of an insurer. 1. The insurer had to be profitable. 2. Its assets, bonds, mortgages, stocks needed to be of the highest quality. And 3. Its market price had to be lower than its private market value. Davis was a value investor in high-quality insurers. And he held on to them. In 1992, 2 years before his death, his top 12 holdings were worth $261 million, about half his total portfolio. Except for Fannie Mae, all were insurance companies. And he had bought each decade ago. His best investment, worth $72 million, was AIG, and his third best, worth $27 million, was Berkshire Hathaway. Once he bought a great business, he never sold it. Why should we reinvent the wheel when we have spectacular successes like Buffett and Davis to emulate? As I will discuss, Davis's success shows that we don't even have to be that good to succeed. Just patient. And so we are. Reason 4, how else do I pay for my mistakes? Shelby Davis bought about 100 insurers that made up 3/4 of his portfolio, and about 1,500 companies globally made up the rest. Most of these investments turned out to be duds. His other big mistake was to buy junk bonds worth about $23 million. Almost all turned out to be actual junk. Davis made all his wealth by investing in a few high-quality insurers and then refusing to sell them. As a result, his hundreds of mistakes became irrelevant in the context of the exceptional long-term compounding of his winners. In his book The Davis Dynasty, John Rothschild states this eloquently. In the final analysis, Davis's mistakes hindered his prosperity the way a gnat flusters a buffalo. Nevertheless, his portfolio proved once again that, over a lifetime of investing, a handful of high achievers' ideas could support a multitude of ne'er-do-wells. I have made many mistakes, and I know I will continue to do so. This is not humility but a cold hard fact. Waiting for a few great businesses to compound has paid for these mistakes. Let me share the actual numbers with you. Our first fund invested about 18 billion Indian rupees, about $400 million using the exchange rate prevalent at the time, in 17 businesses from June 2007 to June 2011. In June 2022, given that enough time had passed, we could reliably assess the share price performance of individual companies in this fund. We had only one capital loss in the portfolio, so that was a failure. Let me arbitrarily label any business, or rather, the market value of the business earning an annualized rupee return of less than 10% a failure as well. 6 of the 17 businesses had earned an annualized rupee return of less than 10% by June 2022. Thus, we had 7 failures, 1 loss and 6 with an annualized return of less than 10% out of 17 businesses, or a failure rate of 40%. But the overall performance of this fund has been better than my wildest dreams. So how did we get here given the underperformance of 7 of our businesses? Because we did not sell our winners. Let me call these 7 failed businesses the Sorry 7. We invested 7.8 billion Indian rupees in the Sorry 7. Let's see what happens when we hold a good business for a long time. Take Supreme, India's leading plastic products company. We invested in Supreme in 2010, and by June 2022 we had owned it for almost 12 years. We invested 1 billion Indian rupees in Supreme, which was worth 13.9 billion Indian rupees in June 2022. The gain of 12.9 billion Indian rupees in Supreme is 1.7 times the total amount invested in the Sorry 7. 12.9 divided by 7.8 is equal to 1.7. But it's much better than that. By June 2022, 6 investments had individually paid for the total amount invested in the Sorry 7. Table 10.4 lists what I call the superb 6. It's almost ridiculous, isn't it? Simply owning Page for 14 years compensated for 7 unsuccessful investments more than 5 times over. If the upside of holding companies for long periods is so significant, why don't investors do it? One critical reason is an underappreciation of compounding, which makes fund managers value IRR more than the multiple instead of the other way around. In finance jargon, IRR is the internal rate of return or the annualized rate of return. If a stock doubles in 4 years, its IRR is 19%, and if it doubles in 3, its IRR is 26%. For the same multiple, the shorter the period, the higher the IRR. Ignoring the beauty of compounding, investors like to boast about the IRR of their investment while undervaluing the benefits of the multiple. If we had been fans of IRR, we would have sold each of the superb 6 listed in Table 10.4 a long time ago. The colossal downside of doing this is evident from the example of Page. In December 2012, after 4 years of our owning Page, it had delivered 65% IRR. For most investors, a holding period of 4 years seems long enough. It would not have been very intelligent to think that we could earn 65% IRR incrementally over the next 5 to 10 years. If we were IRR fans, we would have exited Page in December 2012, crowed about the astronomical return delivered over 4 years, and described the return in bold in our marketing materials. Actually, we don't have any marketing materials, but that is beside the point. The multiple on Page in December 2012 was 7.8 times compared to 82.2 times in June 2022, so the gain on investment was only INR 3.4 billion. Remember that the cost of investment in the Sorry 7 of INR 7.8 billion does not change regardless of the holding period of Page. Thus, if we had sold Page in December 2012, we would have recouped only 44%. 3.4 divided by 7.8 is equal to 44% of our investment in the Sorry 7. The remaining 56% burden would have had to be carried by the remaining businesses. However, since we have continued to hold Page, our gain has climbed to INR 40.8 billion and the sorry 7 have been paid for 5.2 times over by the gain of this single holding. 40.8 divided by 7.8 is equal to 5.2. Remember the example of the rare mutant with color vision, just 8 in 1,000 with only a 1% selective advantage that overwhelmed the population in 3,000 generations? Only a handful of compounders in a portfolio, growing a little more than the rest, achieve the same result given enough time. We invest only in what we think are phenomenal businesses. But I also know that some may not perform and will need to be paid for. Hence, for investors like us, even thinking of selling our winners is worse than wrong. It's foolish. Reason 5. The only way to benefit from compounding is to stay invested. If we are aggressive buyers during adverse stock price movements, logic dictates that we should be aggressive sellers when stock prices rise suddenly. But thankfully, some of the essential things in life, believing our children are unique, falling in love, being a dedicated doctor or nurse during the COVID-19 pandemic, volunteering to be a soldier, are not driven by logic. We don't sell when stock prices rise suddenly. These non-actions during market euphoria have been as important as, actually more important than, our acts of buying during market panics. As I wrote earlier, as of June 2022, out of our portfolio of 24 businesses, excluding the ones bought during the previous 2 years, we had multiplied our money by more than 10 times in INR in 9. Of these, the largest multiple, 82 times, was for Page, and the smallest, 13 times, was for InfoEdge. In 5 of these 9, our holding period had been more than 11 years and we had held the remaining 10 baggers for more than 8 years. Why do we not sell when stock prices rise dramatically? The answer is shown in Table 10.5. Here, I have selected 2 of the 9 businesses whose values have multiplied by more than 10 times in INR. Let me explain what you see in Havells. As of June 2022, we had held Havells for 8.5 years or 2,724 days of trading, not counting holidays. Our gain during this period was 1,270%. From Table 10.5, the following facts stand out. 90% of the gain of 1,270% came in just 35 days. Those 35 days account for only 1.3% of the total number of trading days during which we held Havells. What if we had sold Havells during 1 or more of those very few days? Those 35 days are distributed across all years. For example, the top 3 gains for the stock came on September 20, 2019, January 21, 2021, and June 5, 2014. If, excited by the sudden price rise, we had sold our shares on June 5, 2014, we would have missed the significant jumps on September 20, 2019, and January 21, 2021. As you can see, the numbers for Page are similar. 90% of the total gains came in just 2% of trading days. Havells stock gained 5% or more on just 44 days, or 1.6% of the total number of trading days during our holding period. If we add up the gains from those days, they sum to 1,800%, or 142% of the total gains over 8.5 years. Thus, the 44 days of stock price gains of 5% or more accounted for more than the total gain during our entire holding period of almost 9 years. The opportunity cost of not holding on to Havells shares during those significant days would have been egregiously high. Check out the astronomical impact of 5% plus days in Page. They accounted for more than 300% of total gains. It would have been impossible for us to compound our capital if we had not remained invested in Page. Last, please look at the data from the gloomy days, that is, days when the stock price declined. I was pretty surprised to see that the negative days account for almost half the total number of trading days across all 3 businesses. But, as you can see, the negative days didn't matter because we held onto the companies throughout this period. Do you see where I am going with this analysis? If we had sold Havells or our other compounders on any day when their stock prices rose significantly, we would have been celebrated for raking in cash. Still, we would have repented at leisure as the stock prices continued to rise over the long run. But how did I know that the Havells stock price would continue to rise? I didn't because I cannot predict stock prices. I can make 2 predictions though. First, if we own a high-quality business, the share price will most probably, but not assuredly, react positively over the long run. Second, the share price will rarely make big moves, and if I am not invested in the stock on those particular days, I can bid farewell to substantial potential gains. If we have done anything right, we have not done anything on days when selling seems to be the most logical thing to do. Reason 6, I love our entrepreneurs. I love our entrepreneurs. Behavioral economists have a quaint name for this disease. The endowment effect. It is the irrational mindset that assigns a disproportionately high value to what one owns. Investing is supposed to be a cut-and-dried profession where, a la Mr. Spock, fund managers dispassionately enter and exit businesses based on intellect, instinct, or insight. Unfortunately, we fulfill this requirement only for entry and some exits. Before investing, we base our decision entirely on empirical evidence, as I have shown in chapters 1 through 7. But after we have invested, and if a business continues to do well, I become emotionally attached to it. India is a tough place to do business. I am sure all countries are, but India is the only market I know, and almost every industry is fiercely competitive. In this cutthroat marketplace, any entrepreneur who stays ahead of the competition by taking calculated risks while maintaining high profitability and a clean balance sheet is genuinely admirable. I know that new age technology companies are in vogue, and everyone in the world seems to laud them while they blow other people's money by the millions or billions. Where's the glory in selling $1 for 80 cents? Maybe I am getting too old. In sharp contrast to these cash-guzzling sinkholes, take the cases of Ahluwalia, DB Corp, Triveni Turbine, and Voltamp for companies in our portfolio that are leaders in their field. Like clockwork, they throw up significantly more cash than they consume every year. However, our investment in them has yielded subpar returns for a decade or more. My fault, not theirs. Part of the reason for continuing to own them is that we hope the tide will turn over time, as it has for many of our other businesses. Still, an important motivation is also that I love the leaders of these businesses. They are genuinely outstanding, as shown by their operating and financial track records over many decades. One of the great pleasures of our profession is that we get to know and build relationships with the likes of Shobit Uppal, Sudhir Agarwal, Dhruv Soni, and K.S. Patel. I am in awe of them. So why should I give up this gratification for a few dollars? Reason 7, not selling makes us better buyers. That seems like a weird assertion. How can not selling cause better buying? Here's how. How much time do you think fund managers devote to thinking about the right sale price for their businesses? If you manage money, you already know the answer, but if you aren't a fund manager, please ask someone who is. The answer will probably range from 30 to 70%. Some fund managers argue if we are not a buyer, we are a seller. These people are probably contemplating a sale all the time. Let's say we want to figure out whether we should exit Ratnamani, one of our portfolio companies and India's most significant specialty steel business. Ratnamani's clients are primarily refineries and petrochemical plants, both of which are cyclical industries. Hence, Ratnamani's revenues and profits, too, are cyclical. We first need to decide upon a time frame over which we will calculate the incremental return. It could be 1 year, 3 years, or 5 years, or some other period. At the end of that time frame, we will need to forecast Ratnamani's profits and valuation multiple, P, EV upon EBITDA, or some other metric. If we want to calculate a 3-year incremental return, we will need to forecast Ratnamani's revenues, expenses, and tax rates for the next 3 years. This is a non-trivial exercise for a cyclical business. First, a hapless analyst in the organization will need to trash their weekends to collate the capital expenditure announcements of all the refineries and petrochemical plants that could be Ratnamani's clients. Next, they will need to assume a particular market share for Ratnamani to forecast the company revenue. How, you ask? I have no idea, asked the analyst. Finally, they will conduct a similarly detailed exercise for the significant expense lines, depreciation, raw material, employees, sales and general administration, and taxes, to name just a few. And let's not even discuss the myriad ways of projecting a valuation multiple 3 years from now. Some asset managers may not resort to such a detailed exercise. They may choose to sell if the multiple or the stock price reaches a certain level. But even these professionals will need to keep track of the businesses that approach the sale price and debate whether their initial assumptions are still valid. Example, what if the company's main competitor is in trouble? All this takes time, energy, and most importantly, mind space. We do no such analyses. We buy never to sell. None of our professionals spends even a minute thinking about selling unless the business makes an egregiously wrong capital allocation or if the company, according to us, is irreparably damaged. In the last chapter, in Table 9.2, I showed you the three occasions: the 2008 financial crisis, the 2011 euro crisis. The sovereign debt crisis in Europe that began in 2009 led to the change or collapse of the majority of Eurozone governments from March 2011 to May 2012, and the COVID-19 pandemic, when we were highly aggressive buyers. Given that we were inactive for many years, what allowed us to buy stocks worth $288 million, 16% of the total amount invested since our inception in 2007, in just 17 days in March 2020? We acted decisively and disruptively because we were well prepared. We are always well prepared to buy because we have been freed of the concerns of selling. Just because I have time to think does not mean I will think correctly. I have made buying mistakes and will continue to do so. But freed from the worries of selling, our buying process is highly focused and disciplined. What more can I ask? It does not make any sense. It seems too easy, isn't it? Buy a great business. Sit tight. Watch the moolah roll in. It is, and it is not. Over my decades of investing, I have heard many objections from my fund manager friends and investors who have refused to give us money because they were uncomfortable with our permanent owner approach. It does not make sense is a common refrain after I reveal that we plan to be permanent owners. Let me share with you some of these objections and my responses to them. Objection 1. Why should I hold on to 60 PE? We are price sensitive. We do not invest if the valuation is high. A logical question, then, is why aren't we sellers when the valuation is high? Take a concrete example of a business that went from a PE multiple of 15 times to a PE multiple of 60 times over 5 years of our holding period. Let's say that earnings doubled during those 5 years. We would be sitting on a multiple of 8 times our initial investment, 4 times from multiple expansion and 2 times from earnings growth. Many investors would justify selling at this point with the following calculation. Let's say the business doubles its earnings over the next 5 years, the same as over the last 5 years. If the PE multiple stays the same, we will only double our money, and if it halves to 30 PE, which is possible because the long-term market PE is 19 to 20, we will not make any return for the next 5 years. So shouldn't we be sellers? It's a logical and fair question. It is so logical and fair that most fund managers will sell and exit at this point. We won't. The reasons are threefold. First, I have found that great businesses usually surprise on the upside. What if the earnings triple or quadruple in the next 5 years? Remember that we buy only phenomenal companies. They stand out because they are much better than the competition and usually keep gaining market share and, more importantly, market power. We saw evidence of the increasing concentration of leading businesses across most industries in the previous chapter. Second, valuation multiples generally don't stay benign for great businesses. As I write this, Walmart, with a market value of $400 billion, has a PE of 33. L'Oreal, with a market value of $260 billion, has a PE of 61. We are interested only in stellar businesses. Their valuation multiples likely stay elevated over very long periods. Third, why should I limit my calculation to only the next 5 years? Let's say I am wrong on earnings growth and PE multiple over the next 5 years. Assume that the earnings stay flat and the valuation multiple halves. I will be sitting with a loss of 50% over 5 years. So what? What if the business continues to perform for a decade after 5 years? After 5 years, I will fail to capture the value from years 5 to 15 by selling at a high multiple. Let me share a theoretical case and a real case to make my point. Let's go back to the example from the beginning of this section. I buy shares of company A for $1 in the year 2000 for a PE multiple of 15. In 2005, the earnings have doubled and the PE multiple has expanded to 60. The share price is now $8. If I sell, I will make 8 times my money at an annualized return of 52%. Very nice, right? But I choose to hold. In the next 5 years, the earnings stay flat and the valuation halves to 30 PE. The stock price is $4 in 2010. So I have lost half the capital relative to 2005. I look like a fool. But wait. If the business does well and if the earnings quadruple over the next 10 years from 2010 to 2020, this is an annualized growth of 15%, not an aggressive assumption for a great business. And if the multiple increases by 50% to 45 PE, the stock price would be $24 in 2020. It thus has an annualized return of 17% over 20 years. I have made 24 times my money in 20 years, which for me is a much better outcome than 8 times my money in 5 years. Why? Because I would have made mistakes in between, and as I discussed earlier in this chapter, someone needs to compensate for it. As Shelby Davis has shown us, not all the businesses in our portfolio need to work from year 5 to year 15. A handful will be more than sufficient. Now let me share an actual example from our portfolio. We bought Ratnamani for INR 128 per share from late 2010 to early 2011. The price did not move for the next 3 years, and in January 2014, the stock price was INR 135. We stayed calm and continued to hold our shares because the company was doing fine. However, in January 2015, the share price jumped to INR 700, a 5-fold increase in just 1 year. The earnings had expanded suddenly and so had the valuation multiple. Should we have sold? We didn't. Why? Because the business continued to be stellar. The price stayed around the same level of about INR 700 for the next 2 years until January 2017 before slowly moving upward. In January 2021, the price was INR 1,600. If we had sold our shares for INR 700 per share in 2015, we would have missed the run-up to INR 1,600 over the next 6 years. More importantly, what matters to us is our buy price of INR 128, and relative to this price, INR 1,600 for a 10-year hold does not seem bad at all, an annualized return of 29%. Some may argue that we should have sold in January 2015 to make more than a 50% annualized return. That makes sense, but I prefer a 29% return over 10 years, a 12.5 times multiple, compared to a 53% return over 4 years, a 5.5 times multiple. We continue to own Ratnamani. The answer to the objection, why should I hold on to 60 PE, is straightforward. Because, on average, over the long run, great businesses have a way of making us more prosperous than we ever thought possible. Objection 2. My incremental return will be low from now on. I have gotten over my buying mistakes but will never forgive myself for my only selling blunder. I made it because I feared that our incremental return would dissipate. We invested in a company called Shree Cement in late 2011 for INR 1,700 per share. Shree is the best cement business in India and is probably one of the best in the world. Cement is a highly cyclical business, and we bought Shree when the sentiment in the cement industry seemed to have reached its nadir. Within a few months of our investing, to our great surprise, the cement cycle turned and the stock price more than doubled. While I did believe that we should own businesses forever, I mistakenly thought we should make an exception for highly cyclical businesses. I assumed that we would play the commodity cycle by buying when the sentiment was weak and selling when the mood turned positive. I knew we could not time the cycle perfectly, but I thought we could do reasonably well. I sold Shree for about INR 3,800 per share in October 2012 because I thought our incremental return over the long run would be underwhelming. Instead, we made about 2.2 times our money in less than a year. We returned the proceeds of $80 million to our investors and felt proud to have trounced the market. It was the stupidest decision I have ever made. The cost to the fund? $400 million and counting. The stock price of Shree Cement in June 2022 was about INR 19,009, or more than 5 times the selling price 10 years ago. It hurts. Badly. Having learned the expensive Shree lesson, my response to this objection is incremental over what period? 1 day, 1 month, 1 year, 3 years, 20 years? And why bother if it's a stellar business? The rule for selling a great business is simple, don't you dare. Objection 3. There is a better opportunity to deploy capital. The holding period of stocks has kept falling over the past few decades. Investors aren't trading for the sake of trading, I hope. They sell X to buy Y because they assume Y is a better prospect than X. Shortly after that, they get rid of Y to buy Z for the same reason. There always seems to be something better out there. One justification for this hamster on a wheel behavior is that it is prudent to sell a business with 50 PE to buy a business with 15 PE. Not for us. We never indulge in sell high to buy low activity. We only sell if we have lost confidence in a business, and when we do, we return the money to our investors. The opportunity to own an outstanding business comes along very rarely, and if we have won this lottery, why should we kill the goose laying golden eggs? Yes, I know. I sold Shree Cement. Do I have to be reminded? Look at it differently. I assume many of you own a home or know someone who does. Do you know of any homeowner who trades in and out of their home at frequent intervals? Does a homeowner check the price of their house every day, every month, or even every year to sell it at a high price and buy another one at a lower price? If not, I see no reason to treat holding shares in a business differently. And empirical evidence shows that this strategy does not work. As discussed earlier, there is a strong correlation between a fund's underperformance and its portfolio turnover. I don't know what causes what, and frankly, I don't want to know. We are happy owning a great business and treating it as our home. Objection 4. What should I do the whole day? Believe it or not, a friend who used to work at a hedge fund told me many years ago, but that is a lazy way to make money. He is a rational fellow and did not disagree that money could be made by allowing a few quality businesses to compound. But he considered it almost immoral to make money with no hyperactivity involved. It takes all kinds. He has since left the hedge fund business because he got burnt out staring at his Bloomberg screen 12 to 14 hours a day while worrying about his daily P&L. Another fund manager asked, if I don't trade, what should I do the whole day? This person claims to have made all his money by owning a few high-quality businesses but wants to stay busy during the day. I wanted to say, take a vacation. But I didn't. Different strokes. Investing is a unique profession in which inactivity can be hugely rewarding. It has been so for us. We will continue to be lazy. Very lazy. Mahabharata is one of two great epics of ancient India, Ramayana being the other one. It was written over a few hundred years, starting about 400 BCE. At about 1.8 million words, it is the longest poem known to humanity and is 7 times the length of the Iliad and the Odyssey combined. The epic describes the struggle for dominance between two groups of cousins but is a treatise on moral philosophy and the psychology of human behavior. There is a famous section in Mahabharata called Yaksha Prashna. The spirit or demigod Yaksha poses a series of questions Prashna to Yudhishthir, the eldest and wisest among the cousins. The stakes are high because giving correct answers will revive one of Yudhishthir's 4 brothers killed by the Yaksha. One of the most famous questions posed by Yaksha is, what is the greatest wonder in this world? Yudhishthir's reply is, everyone sees countless people dying every day, but they act and think as if they will live forever. Yudhishthir's insight was that we are strangely blind to a fact that is blindingly obvious. For us, the Yaksha Prashna would be, what is the greatest wonder in the world of investing? With due apologies to Yudhishthir, my answer is everyone sees immeasurable wealth being created by people who never sell, but they think and act as if it is selling that creates wealth. Chapter summary. Evolutionary theory has taught me that reimagining investing requires me to be very patient and not to sell an outstanding business at almost any price. 1. Darwin laid the foundation of evolutionary theory by asserting that if an organism has a small advantage over its peers, say, the ability to run faster, then given enough time, this favorable trait will spread across the entire population. Darwin understood, like no one else before him, that compounding can create macroevolution through microevolution. 2. Investors proficient in mathematics think they understand compounding. But the evidence suggests otherwise. The holding period of stocks is barely a few months. Investors are unable or unwilling to exercise patience and typically press the exit button after meager gains or losses. 3. We have internalized the lessons of long-term compounding from Darwin, and if a business is performing well, we refuse to sell it at any price. 4. Some of the key reasons to stay invested forever are that the richest people in the world are the ones who refuse to sell. Empirical evidence from a 90-year-long study shows that great businesses create enormous wealth. Buffett has shown that the strategy of holding forever works beautifully. Fund managers can pay for their mistakes by allowing the good businesses to multiply, and only those who stay invested can benefit from compounding. 5. Most investors refuse to subscribe to the philosophy of owning businesses forever. This, in my opinion, is a big mistake. 6. We have been successful not because we are better at buying, but because we refuse to succumb to the temptation of selling.